Have you ever wondered how a single development can transform an entire neighborhood? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Today, we're diving into one of the most transformative projects in Ybor City, Tampa, Florida, the highly anticipated Gasworx development. Recently, new renderings and plans have been released, offering a detailed glimpse into this massive venture. The project, covering 50 acres, aims to bridge the gap between Ybor City and downtown Tampa, creating a walkable, pedestrian-friendly neighborhood. The Gasworx development, spearheaded by Daryl Shaw and brought to life by Kettler, will feature 5,000 new residences, 500,000 square feet of office space, and 140,000 square feet of retail space. This ambitious project includes a central Gasworx park, pedestrian-focused walkways on the new 3rd Avenue Paseo, a new streetcar stop, and multiple residences, including both multifamily and upscale leasing options. At the heart of Gasworx will be a redeveloped warehouse transformed into a marketplace with open-air seating, set to become the hub of this new district. This marketplace will be conveniently located near a new park, residences, and an office tower, enhancing the area's appeal. The La Union Apartments, part of Phase 1, have already opened their doors. Adjacent to La Union, the second multifamily development is currently under construction, with completion expected in early 2026. This development will add more residences and retail space to the vibrant neighborhood. Now let's take a moment to compare this with the commercial real estate landscape in Kitchener-Waterloo, Ontario. While Tampa's Gasworx is focusing on creating a pedestrian-friendly environment with a mix of residential, retail, and office spaces, Kitchener-Waterloo has been seeing a boom in tech-oriented developments, particularly in the multifamily sector. This cross-border insight highlights the diverse approaches cities are taking to revitalize their urban spaces. In a significant move reflecting the evolving retail landscape, Colliers has expanded its retail real estate team in San Francisco, responding to a crucial juncture for the city's downtown shopping district. Lassie Jackson Ravina has joined as a vice president, partnering with veteran Union Square broker Julie Taylor. This strategic partnership underscores Colliers' commitment to revitalizing the area, which has faced one of the most severe slumps in recent memory. Jackson Ravina, who previously worked at CIM Group, brings a wealth of experience in urban, mixed-use, neighborhood retail, and high street assets. Her expertise in repositioning and redevelopment, along with a national network of retailer and broker relationships, complements Taylor's long-standing presence and reputation in Union Square. Taylor, with over 1 million square feet leased in downtown San Francisco, is celebrated for her creative deal-making and strong retailer relationships. The downtown San Francisco retail market, particularly Union Square, has been hard hit, with vacancy rates soaring to approximately 22%, a significant increase from 9% in 2019. Despite this, recent months have seen a resurgence, with major brands like Zara, Shoe Palace, Nintendo, and John Varvatos signing leases. Taylor reports active interest and offers on multiple buildings, signaling a potential recovery for the district. However, the recovery is not without its challenges. The closure of Saks Fifth Avenue, following Nordstrom and Bloomingdale's, highlights the ongoing struggles for traditional department stores in the area. Yet, this shift also reflects broader trends, as high-end stores catering to affluent clientele continue to grow, indicating a transformation in the retail landscape. In a notable transaction in Providence, Rhode Island, Horvath Tremblay has successfully brokered the sale of a retail center for $4.7 million. This transaction was completed by Matt Nadler, Aaron Huntley, Bob Horvath, and Jack Laurendo, who exclusively represented the seller and procured the buyer. The retail center, located at 550 Hartford Avenue, is situated in the Hartford neighborhood and was constructed in 1988. This retail plaza, encompassing a 40,526 square foot building, sits on a sprawling 4.43-acre parcel and is fully leased to 10 tenants. The property is anchored by well-known brands such as Dollar General and Advance Auto Parts. Additionally, the center houses a Subway and various local and regional retailers and service tenants, which cater to the needs of area residents. 5 of the 10 tenants have net leases, providing an attractive investment opportunity for passive real estate investors by ensuring reimbursement for their pro rata share of operating expenses, repairs, and maintenance. This setup offers protection against rising expenses, making it a favorable investment. The property has been well maintained, with recent updates including a new facade and roof work, while Subway has also remodeled their store. Positioned along Hartford Avenue, the area's primary commercial and commuter corridor, the plaza benefits from its strategic location at the signalized intersection of Hartford Avenue and Petty's or Glenbridge Avenue. This location provides excellent frontage, visibility, and easy access, being only half a mile from US Highway 6. The property is surrounded by densely populated residential neighborhoods, offering a built-in customer base, and is conveniently located less than 3 miles from downtown and the central business district. According to a recent report by Risk Strategies Co., the commercial property insurance markets are projected to remain soft throughout 2025. This outlook suggests that the market conditions will continue to favor property owners in terms of insurance pricing, while the casualty markets are expected to pose more challenges. The report highlights that despite various industry pressures, the property sector is likely to experience favorable conditions for policyholders. In the context of Kitchener-Waterloo, Ontario, this could mean that property owners and developers in the region might continue to benefit from competitive insurance rates. This is particularly relevant for those involved in multifamily and tenant leasing projects, where managing operating costs is crucial. The soft market conditions could provide a buffer for property owners against rising operational expenses, enabling more attractive investment opportunities in the area. Comparatively, in the United States, regions such as San Francisco are experiencing a rebound in their downtown markets, which might influence insurance dynamics differently. With cities focusing on revitalizing their urban spaces, the insurance landscape might shift accordingly to accommodate these developments. This cross-border perspective underscores the importance of understanding regional market conditions when evaluating commercial real estate investments. Risk strategies. Co's report is a reminder of the intricate balance between market forces and insurance pricing, particularly as it pertains to commercial property. Stakeholders in both Canada and the United States should remain vigilant and informed about these trends to optimize their investment strategies and mitigate potential risks in their portfolios. In the latest commercial real estate news, lending and borrowing activity saw a significant increase of 16% in 2024, reaching a total of $498 billion. This data comes from a detailed report by the Mortgage Bankers Association. Despite the impressive growth from the previous year, it is important to note that these figures are still 39% below the record levels experienced in 2022 during the pandemic-fueled construction boom. The report highlights that dedicated commercial mortgage bankers played a crucial role in this resurgence, closing $411 billion in loans. Smaller and mid-sized depositories filled the gap to reach the total lending figure. Multifamily properties were the primary beneficiaries of this lending activity, capturing an estimated $326 billion of the total. Of this, $219 billion were directly tracked by dedicated mortgage bankers. Interestingly, first liens accounted for 92% of the mortgage bankers' dollar volume closed, underscoring the preference for these types of loans in the market. According to Reggie Booker, the Associate Vice President of Commercial Real Estate Research at the Mortgage Bankers Association, this rebound in commercial real estate lending was primarily driven by multifamily activity and the ongoing strength of mortgage banking firms. While 2021's record origination activity might still be out of reach, the market has shown promising momentum. With an estimated $957 billion in commercial real estate mortgage maturities expected to come due this year, the demand for refinancing and new capital will likely drive significant market activity. This resurgence highlights the dynamic nature of the commercial real estate market and the critical role of multifamily properties in sustaining growth. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.